Welcome to the Swing Trading Blueprint. All right, thank you for joining BST World News. In this course, you're going to learn all of the things that you need to learn to become a successful swing trader. We're going to teach you what exactly swing trading is. We're going to teach you how to find trades. We're going to teach you technical analysis, which to me is the best form to learn how to trade and manage your risk. We're going to learn how to read the chart. We're going to learn what setups are and what setups to look for in order to make sure that you enter a trade at the right time and exit the trade at the right time. We're also going to learn some risk management procedures to help you minimize your risk and maximize your reward and make sure that equation is right every single time you jump into the trade. All right, so thank you guys for joining, and let's go ahead and get into it. All right, so Swing Trading Blueprint. All right. Swing trading has been described as a kind of fundamental trading in which positions are held for longer than a single day. Most fundamentalists are swing traders since chances in corporate fundamentals generally require several days or even a week to cause sufficient price movement to render a reasonable profit. First thing you must understand, when you're swing trading, you are not day trading, okay? This is one thing that we must get clear from the beginning, all right? A lot of people want to learn how to day trade because it seems like it's something that's very lucrative. It's a lot of action. There's a lot of getting in and getting out. This is not day trading. This is swing trading. You're going to go in with the mindset that you're going to hold these positions for longer than a day. When you're day trading, you enter a trade and you exit the trade within 1 day period. All right. In the stock market opens up at 9:30 a.m. Eastern time and closes at 4 p.m. Eastern time. If you enter a trade and exit a trade within that time frame, that would be considered 1 day trade. We're not day trading. We're swing trading. We're going to hold for multiple days, sometimes weeks, sometimes months. Just wrap your head around that and be prepared to withhold any losses or anything that you might see as far as the price movement up and down, with the mindset and the goal of reaching a target. Let the price reach the target, and that usually will take more than a day. All right, so but this description of swing trading is a simplification. In reality, swing trading sits in the middle of a continuum between day trading and trend trading. A day trader will hold a stock anywhere from a few seconds to a few hours, but never more than a day. A trend trader examines the long-term fundamental trends of a stock or index and may hold the stock for a few weeks or months. Swing traders hold a particular stock for a period of time, generally a few days to 2 or 3 weeks, which in between those extremes, and they will trade the stock on the basis of its intra-week or intra-month oscillations between optimism and pessimism, all right? Key takeaways. Most fundamentalists are swing traders since changes in corporate fundamentals generally require several days or even a week to cause sufficient price movement to render a reasonable profit. Swing trading sits in the middle of continuum between day trading and trend trading. The first key to successful swing trading is picking the right stocks. The right stocks for swing trading. The first key to successful swing trading is picking the right stocks. The best candidates are large cap stocks, which are among the most actively traded stocks on the major exchanges. In any active market, these stocks will swing between broadly defined high and low extremes, and the swing trader will ride the wave in one direction for a couple of days or weeks, only to switch the opposite side of the trade when the stock reverses in direction. The right market. In either of the two market extremes, the bear market environment or raging bull market, swing trading provides to be a rather different challenge than in most, and then a market between these two extremes. In these extremes, even the most active stocks will not exhibit the same up and down oscillations as when indexes are relatively stable for a week or months. In a bear market or a bull market, momentum will generally carry stocks for a long period of time in one direction only, thereby confirming that the best strategy is to trade on the basis of a longer-term directional trend. So what I'm teaching in this course is how to be able to find a trend, right? And catch your position when the trend starts, or catch your position in the middle of a trend when it's pulling back. One thing that you'll have to understand about the way stocks move, there's no stock on the market that's going to go straight up. All right. If you see it going straight up, just know that at some point it has to come back down. All right. Stocks move diagonally up, and they move in a way to where there's ticks up, ticks down, ticks up, ticks down, ticks down. You'll be able to enter a stock or enter a position before the trend starts, or enter a position while the trend is already in motion, but we will catch it on a pullback. So what the terminology that we're going to find out and learn about is pullbacks, retracements, all right, sales. They all kind of mean the same thing. When the stock's price drops a little bit in the middle of an upward trend, that's the time for you to look for an entry, not necessarily jump in, but look for entry. I know a lot of you have heard the term buy the dip. When you're buying the dip, what that means is the price is actually dropping and the stock is going on sale. Most people see that as an opportunity for them to jump in and buy. That would be the term buying the dip. When you're buying the dip, it can be very risky, because one of the things that I teach a lot of my students is you never really know when the dip is done dipping. In a sense, there's a way where the stock is going to drop, and then it's going to give you signals that it's finished dropping. Until you learn what those signals are, I wouldn't suggest that you just buy the dip based on what you might see on social media or what you might hear from your friends or other people who are in the market. Buying the dip is a strategy, but you have to know when it's the right time for you to actually buy at the time when the price is going on sale. All right. I always suggest you wait for the bounce so you can see the dip, you watch it dipping, but when it starts to bounce and it shows you that the support level has been established, and we'll get into these terms later, when the support level has been established and it's clear that you can see that the price does not want to go below a certain level, at that point, you start to look at entering a position. But I'm going to show you some tips and some tools and some techniques when we get into technical analysis that will give you a sharper way of jumping into the stocks at the right time with certain triggers and alerts that you can program onto your platform, so you can make sure that you buy in at the right time and catch the trend when it starts. And by the time you purchase that stock, you'll pretty much jump into a stock that will go in profit almost immediately after you purchase, right? So a swing trader, therefore, is best positioned when markets are going nowhere. When indexes rise for a couple of days, then decide for the next few days only to repeat some general pattern again and again. A couple of months might pass with a major stock and indexes roughly at the same time, at the same place as their original levels. But the swing trader has had many opportunities to catch the short-term movements up and down, sometimes within a channel. The channels, trends, breakouts, chart patterns, all these different terms we're going to learn in the technical analysis, and we're going to see that these things actually help us find trades and find opportunities. And when we understand what we're looking at, it'll give us a better gauge on when it's time for us to buy and when it's time for us to invest. Of course, the problem on both swing trading and long-term trend trading is that success is based on correctly identifying what type of market is currently being experienced. Trend trading would have been the ideal strategy for the bull market of the last half of 1990s, while swing trading probably would have been the best for 2000 and 2001. So at this period, at this point where we're at right now, we're coming off of the COVID drop. All right. So during COVID-19, there was a point in around February and March when the stocks, everything pretty much dropped. All right. There was a crash. There was a 30–40% drop in prices for the majority of the stocks on the market at that particular time. At that particular time, the people who understood this information knew exactly how to respond. They purchased. That would be considered buying the dip. Now, when the stocks decided to hit a floor and start to work its way back up, you heard on the news V-shaped recovery. This term, if you go back and look at the news, you can go on YouTube and look at the news during that period of time. You could pull up articles with that time frame, and you'll see that phrase being referenced over and over and over again. V-shaped recovery, V-shaped recovery. They basically told you what type of shape the market was going to look like when we were all done with the COVID drop. V-shaped recovery. We're going to pull up some charts here in a minute so you could actually see it firsthand. But just imagine what your portfolio or what your brokerage account would have looked like if you would have purchased stocks during that time when all of the media analysts told you that it was going to be a V-shaped recovery. Once that peak on the bottom of the V actually occurred, that would be a period of time where you start to establish buying into a position that you were already interested in. And in turn, you would have been able to grow your equity very quickly because the V-shaped recovery happened within a matter of months. And you would have saw that huge swing in the stocks as far as the price is concerned. Now, once the V-shaped recovery happened and the prices started to go up, that right there is a trend. Throughout that trend, you'll see the prices go up periodically, sideways periodically, down a little bit, up, sideways, down, up, sideways, down. We're going to get into the market cycle here in the future, but that's essentially what you want to catch as a swing trader. You want to jump into stocks that are trending up because the stock market is 70, maybe even 80% bullish. It's designed and built for stocks to go up in price. No company wants to publicly list on the stock market and go down in value. Everybody who's in the stock market, all the companies that are in the stock market are there for the purpose of raising capital so that they can use that capital to invest in their business and then grow their business's revenue, grow their business's value, and in turn, it will make the stock price increase. That's the purpose. Understanding that and knowing that will keep you on the right side of the market 80 to 70% of the time, just by going bullish, but understanding that all stocks have a cycle where there's going to be bullish momentum, there's going to be sideways momentum, there's going to be bearish momentum. You just want to make sure that you're catching it at the right time and have a strategy in place to where you can execute and be profitable on each phase of the market cycle. All right, and we'll get into all of that. So using the exponential moving average, simple moving averages provide support and resistance levels as well as bullish and bearish patterns. Support and resistance levels can signal whether to buy a stock. Bullish and bearish crossover patterns signal price points where you should enter and exit stocks. These terms, exponential moving averages, simple moving averages, a moving average is a technical indicator. We're going to break all these indicators down. And I'll also have courses available for you to tap into each indicator individually if you want to get extra help on those. We'll have those available for you at bstuniversity.com. So in a nutshell, the moving averages, what they are is a technical indicator that helps you gauge price movement from previous data that's been collected over a course of days. You'll have dates that you can calculate within the moving averages. So you can go anywhere from a 2-day to a 5-day, 10-day, 20-day, 200-day moving average. Whatever you decide to use on your chart, that number is basically the amount of days of data that you have collected previously to put you at a point on the chart to where the moving average is aligned and it populates new information every day. So we use those moving averages to help with support and resistance, but we also use them to help us gauge what side of the market we're on, whether in a bullish market or a bearish market. And we'll get into all that stuff here in the future when we get to the technical analysis side. All right, but the exponential moving average is a variation of the simple moving average that places more emphasis on the latest data points. The EMA gives traders clear trend signals and entry and exit points faster than a moving average. The EMA crossover can be used in swing trading to time entry and exit points. So you're going to have multiple ways to determine when it's time for you to jump into a stock or out of a stock using these moving averages, but you must understand that moving averages are lagging indicators, which means that the price is going to move faster than the moving averages. So if you're depending solely on a moving average crossover to jump into a stock or jump out of a stock, essentially what you're doing is you're going to be behind every time because they're lagging indicators. All right, just understand that, yes, you can apply this strategy to your formula to get into a trade or get out of a trade, but you must understand that these moving averages are lagging indicators, and you might end up losing or not being as profitable as you could be if you were to react off of price movement first. All right. A basic EMA crossover system can be used by focusing on the 9, 13, and 50 period EMAs. A bullish crossover occurs when the price crosses above these moving averages after being below. This signifies that a reversal may be in the cards and that an uptrend may be beginning. When the 9 period EMA crosses above the 13 period EMA, it signals a long entry. However, the 13 period EMA has to be above the 50 period EMA to cross above it. I know a lot of you guys probably won't understand this lingo as of yet, but I need to read this to you so you understand that first you need to get familiar with the language, all right? And then secondly, you must have examples after this so that it comes together, and we'll get into all these examples here in the near future. But the most important thing that you must understand is that EMAs are moving averages. All right, there's a line that's populated using previous price history and data collected from days. So in this equation, we're talking about the 9, 13, and 50 period EMAs. What that means is a 9-day EMA is 9 days of previous price history calculated into a formula to bring you to a current price history or current price movement. 13-day period, 13 days worth of previous price movement. 50 period EMA, 50 days worth of previous price movement calculated into a formula and giving you a point on the chart for the current day. All right. On another hand, a bearish crossover occurs when the price of a security falls below these EMAs. This signals a potential reversal of a trend, and it can be used to time an exit of a long position. When the 9 period EMA crosses below the 13 period EMA, it signals a short entry or an exit of a long position. However, the 13 period EMA has to be below the 50 period EMA or cross above it. So the most important part of this paragraph here is to me, when the price of the security falls below these EMAs. So when you see the price go below a moving average, that could be used as a signal for you to exit a long position. All right, and we'll get into that strategy here in the future. The baseline, much research on historical data has proven that in a market conducive to swing trading, liquid stocks tend to trade above and below a baseline value, which is portrayed on the chart with an EM in his book, Come Into My Trading Room, A Complete Guide to Trading, 2002. Dr. Alexander Elder uses his understanding of a stock's behavior above and below the baseline to describe the swing trader strategy of buying normalcy and selling mania, or shorting normalcy and covering depression. Once the swing trader has used the EMA to identify the typical baseline on the stock chart, they go long at the baseline when the stock is headed up and short on the baseline when the stock is on its way down. So swing traders are not looking to hit the home run on a single trade. They are not concerned with the perfect time to buy a stock exactly at its bottom and sell exactly at its top, or vice versa. In a perfect trading environment, they wait for the stock to hit its baseline and confirm its direction before they make their moves. The story gets more complicated when a stronger uptrend or downtrend is at play. The trader may paradoxically go long when the stock dips below its EMA and wait for the stock to go back up in an uptrend, or they may be short a stock that has stabbed above the EMA and wait for it to drop if the longer trend is down. So this basically goes into what I spoke about previously, buying the dip or buying the bounce. You see here, when they're not concerned when the perfect time to buy a stock exactly at its bottom or sell exactly at its top. In a perfect trading environment, they wait for the stock to hit the baseline to confirm the direction. So we're waiting for the stock to hit a baseline or a support level. I like to use the term support level mostly because support and resistance are something that you definitely must understand when you're trading, whether you're swing trading, day trading, however you decide to operate as an investor or trader, you must understand support and resistance. Support is on the bottom, resistance is at the top. So when you understand support, you'll be able to see the price hit a support level consistently over and over and over again. That right there is a sign to let you know that price doesn't want to go below this level. So since price doesn't want to go below this level, we can start looking for a long entry here, because it's only one or two ways it's going to go. It's either going to go down or it's either going to go up. It can move sideways, but there's no stock on the stock market that's going to continue to move sideways forever. At some point, it's going to trend up or trend down. Buyers are going to come in. They're going to buy the stock. The more buyers that buy the stock, the heavier the price is going to get, the higher the price is going to get. So you have to be one of the individuals who buy at the right time, get it at a support level, and then wait until the price starts to move up. And then at that point, you'll be in profit and your equity will grow in value. All right. So taking profits. When it comes to take profits, time to take profits, the swing trader will want to exit the trade as close as possible to the upper or lower channel line without being overly precise, which may cause the risk of missing the best opportunity. In a strong market, when the stock is exhibiting a strong directional trend, traders can wait for the channel line to be reached before taking their profit. But in a weaker market, they may take their profits before the line is hit in the event that the direction changes and the line does not get hit on that particular swing. So figuring out when to exit the trade sometimes can be more complicated than figuring out when to get in. The reason why is because patience and their own personal psychology comes into play when you're trying to figure out what direction the stock is going to go. It might have had 2 or 3 days of bullish movement, and then one day you'll get a red candle and you'll start to think to yourself, is it time for me to get out? If I don't get out today, tomorrow it might completely drop and I'll lose all the profits that I just gained over the previous couple of days. Or if I get out now and with this red day, and then tomorrow it goes bullish again and it goes up, I miss my opportunity to gain even more profits when I could have just waited for it to hit my target. This is the reason why you must have your predetermined target and predetermined stop loss before you get into the trade. If you know where your profit is before you jump into the trade, it will help you manage your own psychology and patience and letting the stock get to the point it's going to get to. Now, we're going to use a bunch of different technical indicators to let you know when is the right time for you to get out of a stock. But generally, just know that this is a huge issue with a lot of people who trade, because it comes a point to where your personal psychology will start to reflect on how you act when it pertains to getting in and getting out of a stock. Getting out of a stock, getting out of a position sometimes can be very tricky. And we'll get into some strategies to help you sharpen up those skills. All right. The bottom line, swing trading is actually one of the best trading styles for the beginning trader to get their feet wet, but it still offers significant profit potential for intermediate and advanced traders. Swing traders receive sufficient feedback on their trades after a couple of days to keep them motivated, but their long and short positions of several days are of the duration that does not lead to distraction. By contrast, trend trading offers greater profit potential if a trader is able to catch a major market trend of weeks or months, but few are the traders with sufficient discipline to hold a position that long without getting distracted. On the other hand, trading dozens of stocks per day or day trading may just prove too white knuckle of a ride for some, making swing trading the perfect medium between the extremes. So there's going to be people who are just starting out, people who have been in the game for 20, 30 years, people who are been in that middle range, all experienced swing trading, and will tell you that that's probably the best way to go, because it's less risky than day trading or options trading or an advanced style that might put your money at risk and put you in a place to where you lose more money faster than you could potentially gain it. So swing trading is definitely something that beginners should start out with. All right, so key takeaways. Swing traders typically try to buy stock, hold it for 2 or 3 days, then sell it at a profit. Not all stocks are suitable candidates for swing trading. The best candidates have sufficient liquidity and steady price action. Facebook, Apple, Microsoft are suitable stocks for swing trading in certain market conditions. To see if swing trading makes sense for you, consider practice trading before risking real money. We call that practice trading or trading with a platform like Robinhood or beginners platform might not necessarily be available for you to do that. What we do is we use a platform called TradingView, which will allow you to trade with no money, which basically is practice trading. So we basically call that paper trading. You're trading with paper and not real capital. All right, that would be great. All right, so let's get into a few stocks that that you might want to start out with. All right, let's go into that. So 3 stocks for novice swing traders. All right. So swing traders buy a stock for a few days, then sell it for a profit after the price has moved higher. We understand that. That's the goal. If this interests you, the best way to learn quickly is by picking the right stocks to buy in the first place. First, look at large cap stocks because they have numerous shares changing hands at any given minute, and this makes them easy to buy and sell quickly. In other words, liquidity is an essential factor to consider when searching for swing trading candidates. So you want to jump into stocks that have a high amount of volume and a high amount of liquidity, because one thing that you don't want to happen is you put your money into a stock or into a company and you gain profit and the stock price actually reaches your target. And then when it's time for you to close that position or sell, nobody's there to buy it from you. You're only going to be able to make profit if you're able to sell your position higher than what you purchased it for. If there's nobody on the other side of the trade and nobody wants to purchase that stock at that particular price, then you're dealing with a liquidity issue, and that's not good because now you have to sit on that asset and you can't do anything with it. And that will put you in position to potentially lose money because eventually we know the cycle is going to happen, stock price is going to drop. And if it drops below the point at where you purchased that, you're going to sit with a loss and nobody's going to be able to take you out of that position. So you want to make sure you stay in very liquid, high volume stocks to make sure that you're going to be able to get in and get out whenever you want and not have to worry about nobody being on the other side. All right. So picking swing stocks. Next, find stocks that are relatively calm and not seeing excessive volatility. Don't look for huge moves. You should look for stocks that are trending slightly up or down with steady price action, but without too much drama. You're trying to make a living instead of making a killing. We picked these 3 stocks for their liquidity and steady price action. Start following these stocks and make paper trades. Then move on to real trades with real dollars. Teach yourself to see the signs of when to buy and when to sell, but note that market conditions often change and often an approach that worked before might not necessarily make profits in the future. All right. So these are just examples. There's hundreds and thousands of stocks on the market that might even be better for you to trade. But we're just going to go through these as an example so that you can see what we're looking for essentially for entries and exits. All right. So Facebook is a great stock for learning how to trade with trend lines. When you look at the stock chart, you can see that the stock zigzags upwards. The low points in these patterns all line up. You can draw an approximate line across these low points. That is the lower trend line. Every time the stock hits that line, it goes back up. What makes this stock especially good to start with is that the bottom trend line is already drawn for you. Make sure your chart has the 50-day moving average. This is the bottom trend line for the particular stock at this time. So what we're going to do now is we're going to go and we're going to pull up Facebook on our chart. Now we got Facebook here, right? And these 3 lines, just so you know now, these are moving averages, okay? Right here, I have the 20 moving average, the 50 moving average, and the 200 moving average in red, all right? Now, this is Facebook. Now, I mentioned trend lines, right? So what a trend line is trend line is a line that you can place at the bottom of price movement and actually use that as a gauge to find your support level. Remember, we talked about support and resistance, right? So with support and resistance, you have to spot those first so that you know where the bottom of the price movement is. And then also the resistance level will be the top of where the price movement is. And then you put both of those together, and this formation right here is called a channel. All right, so now we're looking at a channel. So you see the price moving inside the channel on the bottom all the way to the top. bottom, top, bottom, top. When we're trading, you want to find a position when the stock gets to the bottom of the channel and trade it all the way up to the top of the channel. That's essentially what we're trying to do as traders. And that would be a perfect entry and exit on a stock like Facebook. Facebook, high volume stock, you know it's going to move, all right? Even if it moves sideways for a few days like it did back here from June 1st all the way until about, what's that? From June 1st all the way up until June 23rd, June 22nd, this little range right here, sideways movement, where the price just moves sideways up inside this little price range and then it broke out again. All right, that right there, when we talk about how tricky exiting trades are, that would make a lot of people get out of a trade. If they jumped in here and they wanted to trade it all the way to the top of the channel, but then they had a long period of 2 or 3 weeks where it was just sideways movement. In between this sideways movement, people were getting out of the trade, right? Getting out, in fear of it actually turning back around and dropping back to where they got in at. And then it turned around and went up. And the people who stayed in got profit. The people who didn't, it was sick to their stomach. So we're going to learn the psychology behind that. But this is the channel, all right? This is the support level with this trend line, and then the resistance level with this upper trend line. We're going to learn how to draw trend lines in the future, but this is essentially what you're looking for, a tradable asset, all right? This is tradable because there's high points and there's low points. And then there's points where there's sideways movement, which essentially give you an opportunity to buy in with the understanding that no stock is going to just move sideways forever. At one point, it's going to jump up or jump down. You just want to make sure that you get in at the right time and you're right about which direction it's going, right? So this is Facebook. Now let's get back to the presentation. All right. So with Facebook, let's get back to where we were. So with Facebook, that would be a great stock for you to start out with. And I'm not going to just say, oh, Facebook, this is what we're going to focus on. That's an example, and we're going to have multiple examples. But what you want to do is make sure that you keep the best stocks on your radar. So when you know that it's time for you to purchase, you're not caught off guard. You've been watching it the whole time and you're seeing how it's dropping. You're seeing how it's giving you a sale. You're seeing how it's bouncing off support and showing you that it doesn't want to drop below a certain level. You're seeing how it's consolidating, which is sideways movement. And you're waiting for that point in where it's looking like it's about to break out of that consolidation zone, jump in, and then you're ready to make your purchase and make some money. All right. So similarly, you can draw trend lines across the highs of the stock. When Facebook reaches that upper trend line, it tends to drop back down to its bottom trend line. Note that these trend lines are approximate. You have to get the knack of knowing when the stock price is about to turn rather than count on a strict adherence to trend lines that you have drawn. Approximately 16 million shares are bought and sold daily in October 2020. So it is easy for you to find buyers and sellers. This means the stock is liquid and you probably won't get stuck with it if it starts to drop, all right? So we have a few more stocks that we're going to go into as examples, but we just want to make sure that you guys understand exactly what swing trading is and how to respond. Now, today is right now it's 1:32 p.m. The market is open. Okay. This chart that I'm looking at right now, this is the daily chart. All right. So on this chart, what this means is every single candle on this chart is 1 day. Okay, 1 day. All right. So for today, Facebook, not a lot of movement. Okay. This candle right here would be considered a doji, right? And we're going to get into candlesticks and how to read them. We're going to get into chart patterns and how to read them. But this today, one candle for the day. All right. Candlestick is a doji, which is a misdirection or not really any direction. But it did actually open high. All right. And we'll see exactly where it ends up for the rest of the day. It's 1:33. The stock market is going to be open for another 2.5 hours. So we're gonna see where Facebook closes at. But as you can see, if we would have got in Facebook here or even here at the bottom of this channel, we'd be in a good amount of profit right now. And really, we'd be profiting about 7.11% from where we would have entered at on the bottom of this channel just by trading Facebook. And we're going to show you guys how to manage your positions once you get in them so that you are able to maximize your potential profit and know when it's the right time for you to exit. All right, you see this right on the right side of my screen, these messages popping up. That is the Discord channel. For those of y'all who need extra help, you need extra guidance, we're open 24/7. There's people who have been trading with me since the beginning of 2021. They're all in the chat. If you need any extra help, make sure you tap into the VIP membership. You only get access to the Discord channels if you are in the VIP membership. All right, so use that as your as you need it. And then we also have weekly meetings every single Sunday at 7 p.m. Eastern time, where all of the VIP members meet via Zoom, and we go over our potential plays, entries, and exits of the week ahead. And we have a weekly playlist that I give out to all of my VIP members with at least 10 or 20 stocks on them. So we all have a pick of the litter when it comes to the best stocks to trade throughout that week or throughout that month. And this is how we make money consistently. All right. So this is wrapping up the introductory class of swing trading. Hopefully you guys learned enough to start you out on your journey with an understanding of what swing trading actually is, how to be profitable, what all of these terminologies mean, and which stocks you want to look at to start trading. And we're going to go ahead and get into the next class. Thank you guys for joining.